China's government is advising banks to do stress tests, entertaining the idea of a 60% drop in property prices. For more on a potential bubble burst in China, we partner now with the FT to bring you Lex on Bloomberg. You get a sneak peek at the Financial Times' flagship column a day early. Louise Lucas is joining us now live from London. Louise, glad you could join us this morning. What is the Chinese government doing in terms of these stress tests? I mean, why is China having to do it?
What this is showing is that China is concerned about a property bubble blowing, particularly in the coastal cities. We have seen prices rising very sharply in places like Shanghai and the other coastal cities. The government is now saying, we are scared. The fact that they're actually telling the banks to look at a worst-case scenario of 60% suggests that they're really seriously worried about what's going on in this market.
Yeah, Louise, we know that's double what had previously been advised at 30%. Is the Chinese government going to be successful in fine-tuning these tests?
They've got a really difficult task ahead of them. On the one hand, China needs property. It has to have 10% or thereabouts economic growth. If it starts losing that, you lose jobs and so on. And construction, the property market, is a big part of that. On the other hand, they do not want speculation. They're very keen not to see the sort of bubbles they've seen in Hong Kong across their border and then in virtually every other market we can care to mention. Will they be successful? They've had various efforts before, most recently in April 2007. That did work. That did bring prices down by about sort of 15% or so. But it took a year for them to achieve that.
And Louise, we know that the government has already banned third mortgages, and they are making people put more money down even for second mortgages. Louise Lucas, thanks very much joining us there from the FT in London.